Okay. So a lot of investors hold concentrated positions in individual stocks. Now that can happen a lot of different ways. I have a line here that's kind of a joke, but it can happen when you hear Charlie Munger say that diversification is for the know-nothing investor without realizing that he's talking about you. It's kind of a dig at people, because Charlie Munger has said that, but I think a lot of people hear that and say, well, that's not me. I'm not the know-nothing investor. I'm going to hold a concentrated portfolio because Charlie Munger said so. But of course, Munger, when he was alive, and Buffett are very different from most people. Anyway, so I think a lot of people do hear Buffett and Munger talk about diversification being silly and concentration being smart if you know what you're doing. People hear that and think, well, I know what I'm doing, so I'm going to concentrate my portfolio. So that's one. It's kind of like an overconfidence type thing, I guess. But then there are other reasons like, and we see this all the time with clients, being part of a company that went public and holding onto your stock, either because you wanted to, because that's what everyone else was doing, or because you were in a lockup or whatever, and the price went up. All of a sudden, you've got this huge position in a single stock. Or even just like a lot of people get a portion of their compensation in employer stock. So it could be other things like owning stock in an employer that has it's just performed so well over time that it becomes a big part of your portfolio. I mean, I can imagine working at NVIDIA and receiving equity compensation, and then all of a sudden it's like, oh, wow, I've got a very concentrated position.
Or if you sell it and you got a low cost base.
Yep.
I'm sure I mentioned that discussion around a client that held Nortel a long time ago.
No, I don't know if you have. What do you?
I don't know. I'm jumping ahead in your notes here now, but it's a cool story. This goes back to Nortel's soared in 2001 to, I forget the price. Doesn't matter. I think it was like in the low 100s. So I had one client that had this huge concentration position in that single stock Nortel. And I can't sell it because the tax will be so expensive. That was the tax advisor's advice. And so my colleague at the time did the math and said, well, if it goes down below whatever, $91, you will have evaporate all the tax savings. So if you think there's a chance it goes below 91, you should sell because it's irrelevant, right? Oh, no. Went back and forth. The advisor went right to the wall, convinced them to sell. So they sold almost at the peak.
Oof.
And we all know what happened to the Nortel share price.
Yep. Yeah, that's one of those types of stories where you look back and it's like, wow, a lot of those employees had huge concentrated positions in their employer stock.
And they just loved the company, which is great. I think they'd done a butterfly transaction from Bell, right? So if you own Bell shares, you own one of them. I forget which one owned which. I guess Bell owned Nortel, and it spun out. So a lot of people viewed the Nortel shares as free money, which of course it wasn't. Interesting dynamic that's 20 plus years ago.
Yeah, it's a great example and super relevant to the topic that I'm going to go through here. So in any case, however you end up getting there, owning this concentrated position in a single stock, and to the point of the example you just gave, I don't think people are aware of how risky individual stocks are. And we know that in aggregate, and this is kind of the Scott Cederberg stuff, but other people have covered this kind of idea too. In the long run, in aggregate, stocks are probably a bit safer for long-term investors than I think a lot of people realize. But I think individual stocks are way riskier than most people realize. And one interesting thing that comes out of some of the research that I'll talk about here is that is especially true for stocks that have performed well in recent history. That the chances of a stock that has performed well of an individual stock that's performed well in recent history underperforming in the future, the chances are greater and the magnitude is also greater. And like, which stocks do people tend to own concentrated positions in? Well, the ones that have done well recently, not the ones that have done poorly. So what I want to do in this episode is detail how risky individual stocks are, which again, I don't think most investors appreciate that, and also cover how many stocks are needed. And there's no single right answer here, but I'm going to talk through just how to think about how many stocks are needed for a portfolio to be diversified and why it's more than the commonly cited sort of 20 to 30 stocks, which is a number that I hear thrown around quite a bit. That's a number that is based on research, but it's based on research that's from many, many years ago when we didn't know quite as much about financial markets and when risk was framed in a different way. Now, one of the reasons I think this is an important topic is that it's pretty well documented that individual investors do quite commonly hold concentrated portfolios. I saw some research showing that, at least in their sample, individual investors on average held between 3 and 7 stocks, which is it is crazy. And like I don't have really good data on this to confirm, like, what does it look like for, if you go to, Questrade accounts across Canada or TD direct brokerage accounts across Canada, what are those portfolios? I would love to know. I don't have those data. But if you talk to people who don't invest in index funds, but invest in stocks, or if you look at the investing subreddits where people are talking about the stocks they invest in and their portfolios, that 3 to 7 number actually doesn't seem too crazy. That's anecdotal, but anyway. The 3 to 7 is based on research, but anecdotally, it's not actually that crazy for me to believe that it's good data.
Guess they haven't heard of Bessembinder.
Yeah, they probably have not. If they're or they have, and they think that they're holding the 3 to 7
you're right.
stock.
Yeah, you're right.
That's the thing with Bessembinder; it cuts both ways.
Cuts both ways. Yes.
Yeah. Yeah. So, and that concentrated portfolio behavior that is more pronounced, and there was a paper on this too, that is more pronounced for investors who overweight. Well, it's actually to your point just now, Cameron, who overweight the unlikely probability of a big win relative to the much more likely probability of losses or underperformance. So if that's you, and I suspect it's not many of our listeners, but if it is you, listener holding a concentrated portfolio of stocks, then you're going to want to hear us out, I think, in this episode.
Do you think it's the humans' tendency to like stories over math? Like, stories of stocks can be very compelling, which can drive your conviction.
Yeah.
I know there's no evidence. I'm just thinking of what could cause that.
Well, there's no evidence of that exactly, but if you kind of go up a level of abstraction, there is evidence that people overpay for growth, right? Like I think stories are probably a big part of that. Narratives matter. So in individual stocks, of course, are exposed to something called idiosyncratic risk, and that's risk specific to that company, like what its CEO happens to tweet or whatever random thing that happens specific to that company, like separate from what's happening to the broader market or even to similar companies. It's a type of risk that does not have a positive expected return. So in general, and this is pretty basic portfolio theory thinking, investors should try to avoid idiosyncratic risk by diversifying their portfolios. A broadly diversified portfolio, like take a total market index fund, is primarily exposed to market risk, which is, again, a risk with a positive expected return. Now, the cool thing about diversification is that it reduces risk without reducing expected return. You're reducing your idiosyncratic risk. You're not reducing your portfolio level expected return, which is why diversification has been referred to as the only free lunch in investing. Typically, if you want more expected return, you have to take more risk. Or if you want less risk, you have to reduce your expected return. Diversification is the exception.
Exactly.
Now, if diversification is the only free lunch in investing, I've got another joke here. I don't know. See how it goes. Then portfolio concentration is like ordering fugu prepared by an amateur chef. Fugu is the poisonous puffer fish.
Okay. Now the joke's funny. Okay.
If you prepare it wrong, then it's...
If you have to explain the joke, it didn't really land.
In my YouTube video on this topic, I did have a clip from The Simpsons with an amateur chef very nervously preparing fugu, and I'm pretty sure Homer ends up getting poisoned, so maybe it was better with a visual aid.
Such a great episode.
Poison, tasty fish. Concentrate.
I want fugu!
Okay. So a concentrated portfolio, what does that actually mean? We have to put some definitions around it. I'm going to call it a portfolio with a single position that makes up 10% or more of its holdings by weight. Now that is a figure that's based on one of the papers that I'm going to reference later in the episode. The most concentrated position would be holding one individual stock, or maybe levering up one individual stock. I don't know. But one individual stock is as concentrated as you can get in a single position. And then each additional stock after that makes the portfolio more diversified. The reason that concentrated portfolios are problematic is that they allow the idiosyncratic risk, that uncompensated random risk of the individual company, to have a meaningful influence on the outcome of the portfolio as a whole, which isn't great. Now, that wouldn't be terrible if most stocks performed really well. Like if every individual stock earned the market return, it's like, oh, who cares? We don't need to diversify. But the data on individual stock returns, they're pretty sobering. Like you mentioned Bessemer, Binder, Cameron, and that's some of the data I will talk about, but there's a bunch of interesting research on this. One of the most accessible, and this one's been around for a long time too. I think Bessemer Binder does reference it in his paper, or at least he acknowledged it when we talked to him. But JP Morgan puts out this occasionally updated report called The Agony and the Ecstasy. And it's all about individual stock returns. So they look at the range of outcomes for individual stocks, and they slice the data up different ways in various issues of this report. I think they've been doing it since 2005. They've come out with a few different versions of it. In the 2021 issue, one of the data points that jumps out at me, and I just find fascinating, is the frequency of catastrophic losses. So that's defined as a 70% decline in price from peak to trough, which is never recovered from. And so now we're talking about the Russell 3000 here. So 3,000 stocks in the U.S. market that make up a huge portion of the U.S. market. 44% of companies that appeared in the Russell 3000 index from 1980 through 2020 experienced a catastrophic loss.
Wow.
Right? Some sectors like energy, they slice it up by sectors. Energy, information technology, they have even higher frequencies of catastrophic losses. So that's like a staggering number. 44% of the stocks that appeared in the Russell 3000 index, which is representing most of the U.S. market over this 1980 to 2020 period, experienced losses of 70% or more that they never recovered from.
And the question is, how do you behave when that happens?
That's part of the question, but it's also just like, what does that do to your financial future if that was your one stock?
Exactly. Yep. Yeah, because it doesn't recover. So even if you behaved well and held on to it, it doesn't mean it's coming back. Like
that's what I'm saying. We don't get that
market return.
Right. That mean reversion that tends to make stocks in aggregate, the stock market, a little bit safer for long-term investors than I think people generally think. This idiosyncratic risk or the potential for catastrophic losses that you never recover from, like that, it just makes individual stocks a lot riskier than I think people imagine them to be. Now, I don't think it should be too surprising. Like that, the first time I read that statistic, I was like, wow, I didn't expect it to be that high. But capital markets are highly competitive. They're driven by creative destruction. Some companies are going to succeed to the point where they displace companies that had previously been successful. And some companies are going to fail or at least struggle to compete. And that'll be reflected in their prices. So like we know in aggregate stock returns are positive, and we expect that to continue for the same reason, creative destruction. But within those positive aggregate returns, there are going to be a lot of losers. Another interesting point from the JP Morgan report is that despite the S&P 500's incredible performance of the index as a whole, hundreds of companies cumulatively have been removed from the index over time due to business distress. That's also an interesting point because if you took that diversified portfolio of companies that were removed from the S&P 500, I think they've probably performed quite well.
Wow.
But it does drive home the point of creative destruction. Now, the other issue is the skewness point. So that's the fact that the idea that there are by number of stocks, there are much more losers than there are winners. The winners tend to win really big, but there aren't as many of them. So over the 1980 to 2020 period, 42% of stocks included in the Russell 3000 had negative absolute returns. Negative. 42% of stocks. 66% of stocks trail the market, trail the Russell 3000 as a whole. And then 10% did beat the market by a cumulative over the full period, 500% or more. So in the JP Morgan report, they call those mega winners. And that phenomenon, what the distribution that I just described, that's called positive skewness. Most stocks perform poorly. A few do exceptionally well. And I think the investors holding individual stocks are overweighting the probability of holding a mega winner and underweighting the much more likely probability of holding a loser.
It's so interesting to think of why. Like, is it the greed? Is it the over-optimism? Is it you have an optimistic bias in general? Like, look at this evidence. Is it glass half full or glass half empty?
Yep. It is an
It
interesting
takes
question.
all those characters to make a market. It's so interesting to think of what goes on.
Yeah.
And then when you think of who's on the other side of the trade, that's where my head goes. Like, when you're buying or selling, there's someone on the other side. You have no idea who it is, but it's likely someone pretty sophisticated.
Yep. Just by volume of trading, it probably is someone sophisticated.
Yeah. But then if you get one right, I assume if you get one right and it's a massive winner, it must be so intoxicating. That builds up your confidence. So I think we all get it. It's an incredible phenomenon.
So I've already released a YouTube video on this topic, and the comments were fascinating because there were people who have beaten the market by picking stocks, and they think that I'm completely insane for saying that you can't beat the market by picking stocks. And of course they'd think that based on their own experience. But then there are also a lot of people who have lost a lot of money picking stocks, and they're saying, yeah, this video makes a lot of sense. And then in some cases, there are little comment discussions where the people who have made money picking stocks are debating with the people who have lost money picking stocks, whose experience is more representative of what people should expect. But it's hard, like when you have a lived experience that's like, I picked stocks and I beat the market, being convinced that you were lucky or that you won't be able to repeat that outcome again in the future, that's not easy to convince somebody of. Because like, hey man, I lived it, I did it. We will show in the video here. We can show the distribution of stock returns from 1980 to 2020. We'll pull the chart up. But what you can see is that most stocks underperform, kind of as we've been saying. A relatively small portion match or beat the market, and a few do exceptionally well. And that's the positively skewed distribution. That means, as per what Bessenbender talked about when he was on, if you're selecting a small number of individual stocks for a long-term portfolio, it is much more likely that you pick stocks that underperform than you pick stocks that outperform. And that's why diversification makes sense in general, and why total market index funds in particular, which hold all the stocks in the market, are so hard for active management to beat. That intuition is detailed in the 2017 paper, Why Indexing Works, which shows, using just a simple kind of toy model, that when the distribution of returns is positively skewed, randomly selecting a subset of securities from the index dramatically increases the chance of underperforming the index. And then that simple model is, of course, validated by Bessenbender's paper, Mutual Fund Performance at Long Horizons, where he finds that the pre-fee returns of only 45.2% of actively managed U.S. equity mutual funds beat the net of fee returns of SPY, an S&P 500 ETF, over the same period. That to me is crazy, that only 45% of pre-fee mutual fund returns before fees beat the net of fee returns of SPY.
Wow.
Right?
Pre-fee.
Yeah, I know. It's wild. So that's before you've even taken, and that's just the skewness. That's the skewness of returns.
Yeah.
You add in fees and looks much worse. But the fact that you're more likely to underperform before fees because of the skewness, I think, is kind of the main, and those are much more diversified portfolios. Like that's actively managed funds tend to be fairly concentrated, but relative to, 10 stocks that an individual investor might hold, they're much more diversified. Yeah. I do think, like, to your point, Cameron, about what is driving this, I think one of the reasons is likely that investors holding in individual stocks think they know the companies that they own, and that they understand the distribution of potential outcomes, and the risks and opportunities that investment represents. I would call that familiarity bias. Investors are more comfortable with what they know, There's probably some illusion of control bias too, where investors feel like they have some level of control over the outcome because they've done research or because, I don't know, maybe they work at the company or they know the management or whatever. But I think the reality that investors have to understand is that the factors that drive underperformance and the catastrophic losses that we've mentioned are really unpredictable. And again, the JP Morgan study has some interesting data on this. They look at how things like commodity price risks that cannot be hedged away, changes in government policy, deregulation and re-regulation of industries, foreign competition, trade policy, and fraud by company employees are some of, in their sample, are some of the completely unpredictable things that have caused past business failures. And their commentary on this is that these are just things that no matter how well a business is run or how well you understand it, they can completely blindside its profitability, which can lead to big stock price declines. I think another thing is that the declines happen quickly and unexpectedly. Another one of the comments on my video on this is that, like, oh, you've never heard of a stop loss. I don't know. I guess if you have that in place, maybe it'll help on the downside. But I think these declines happen quickly and unexpectedly. And the 2024 issue of JP Morgan's report, they do show a chart with a sample of companies that have experienced catastrophic losses. And they've got the magnitude of the loss on the y-axis and the maximum monthly rate of decline on the x-axis. And it shows that companies of all sizes have experienced big losses that happen really quickly. Like the average monthly losses are just enormous. So by the time that it's going down, it's in many cases going to be too late. And the other thing is, once it's going down, people will want to hold on to it until it's recovered. It's gone down. I'm going to hold on to it until it comes back up. That's the disposition effect. But with the catastrophic loss data, we know that in a lot of cases, once the stock goes down like that, there's a good chance that it never recovers or even continues to decline.